Hi, it's Neil here. Welcome back. This is Learning Module 5, Chapter 5 of the textbook. And here we are going around the hexagon, Chapter 5, recognizing the symptoms of fraud. Yes, you've got to believe it, because fraud you cannot see. So you need to look for symptoms. And so the learning objectives in this chapter, and it's quite an exciting one, is understand how symptoms help in the detection of fraud, identify and understand the accounting symptoms of fraud, the internal controls that help deter and detect fraud, the analytical symptoms of fraud, lifestyle changes, behavioral symptoms that help detect fraud, and the importance of tips and complaints as fraud symptoms. Yes, you've got to believe it, because where we were last 2 weeks were in the area of fraud prevention, where we looked at creating a culture and we looked at eliminating fraud opportunities. But now that is too late. Whether we had those things in place, if fraud is occurring, we need to be able to detect it. And that's what these coming weeks are all about. And this week we're looking at the symptoms, what to look for, because the fraud itself, for the most part, is invisible. Wow. So we all know that fraud detection can be put down into 3 acts, and that is the theft act, the concealment, and if I move my big head right here, it's the conversion of what you have stolen into money so you can go and spend it on your holidays, your BMW, or what have you. Let's get into the symptoms, shall we? Here are 6 basic symptoms of fraud. Now, there is 5 that are grouped together, and then there's a 6th. And I want to highlight the 6th one as different, but it's called a symptom for particular reasons we will go into. Let's look at the first 5, and they are the accounting anomalies. So to do with documentation problems, debit credits, falsification of the accounting records, analytical anomalies, where you look for patterns or irregular patterns, not just in the accounting, but in other data that is representing the business in which the fraud may have taken place. You have the internal control weaknesses, which we're all aware of, system vulnerabilities, for example, separation of duties, having 2 people sign off on a check or some purchase order or payment order, unusual behavior by the fraudster. We have extravagant lifestyle. Remember, we've got to convert what you stole into some money, and then we've got to spend it on our holidays, on our first class tickets, on our Lamborghini, and whatever. Excessive spending. Yes, you've got that. And finally, we have tips and complaints, and that is the 6th one I want to talk about. It really isn't a symptom, because a tip or a complaint isn't a direct result of a fraud taken place. A fraud does not cause a tip or a complaint to occur. It's just that when a tip or a complaint is made, it's not a guarantee that a fraud has occurred, because people might complain or put in false tips because they don't like a particular person in the organization. So it's only an alleged fraud. So that's why we call tips and complaints a symptom. All right. A symptom isn't a guaranteed fact that fraud has taken place, but it does give you a signal to investigate further. So there you have the 6, and we can put that down into the alphabet, A, B, C, D, E, F. All right. A, accounting analytical anomalies. B, behavior. C, internal control. D, accounting anomalies, documentation. D for documentation. E, extravagant lifestyle. And tips and complaints we could put down for F. That is false messaging, something like that, something to do with F. But at least we try and remember these, A, B, C, D, E, and F. There you have it. Let's get into these 6 areas, shall we? So before we get into these 6 areas, let's have a look at the highlighted case in Chapter 5. And that is the case of Elgin Aircraft. And what was interesting, the big symptom was the E, extravagant lifestyle, the unusual lifestyle of one of the employees. And that was, the employee was riding around in a limo and spending lunches on all of her employees. The person in question was the claims payment department manager, and she created false records of 22 doctors that put in claims to Elgin Aircraft. And when they went through the claims processing department and then came across her desk to pay the money, she just signed off. She approved and signed and paid those 22 false doctors directly. In the end, she embezzled over $12 million over 4 years. Now, how was it found out? It was found out because she was spending money on limousine, taking her staff out to extravagant lunches. She had no vacation over 10 years. And that was a behavioral sign that she was staying in the organization to make sure that her department, that is what was being signed and approved as a claim payment, was always running across her desk. So she had control over concealing the fraud, so there would be no irregularities taking place that could be picked up. So someone noted suspicious activity, and that's what we got here. The defense auditor notices the manager's extravagant behavior and started an investigation into this manager and found that the manager had an impeccable record. And the defense auditor speaks to the VP of Finance, and then they investigated the claims payment department to see what was going on. And that's where they found out that, wow, there were all of these 22 doctors that were fictitious. And what revealed the fictitious doctors and the payments made to the dummy doctors were just the fraud investigation. All right. So what started the investigation was the unusual behavior of the claims payment department manager in excessive spending on limousines and taking her employees out to lunches all the time. And then that started the investigation. And that's where they were able to dig deeper and discover the fraud. Then in the end, notice that it was an internal control weakness as well. So let's have a look at what led to tip off the investigation. It was basically 2 out of the 6 symptoms. The first one was the extravagant lifestyle, riding around the limousine, taking the employees out for extravagant lunches. And number 2, the strange behavior of the manager in not having taken annual leave for 10 years. Okay. Now, the third possible symptom was the significant internal control weakness, but that was only found out later on. Wow. So let's get into those 6 areas or 6 symptoms of fraud that, we're supposed to not be able to see. Let's have a look. The first is accounting anomalies. And I put that, remember, it's a documentation that we are looking for that is creating a symptom. And there's lots of words here in this flowchart, but note this: accounting anomalies can be in the area of faulty journal entries. Okay. And some of these could be errors. Some of them could be deliberate. Inaccuracy in ledgers, again, this can be an error or deliberate fraud, right? So control account discrepancies, okay, where a particular control account of all accounts receivable doesn't balance with all the customers that owe you money, or accounts payable don't balance with all the claims that suppliers have on you. You've got to have that reconciliation, or the ledger doesn't balance. Parts of the ledger does not balance. Source documents is another symptom. And any of these could be symptoms of an accounting anomaly. All right. Duplicate payments, missing documents, common names and addresses. Actually, if you look at a lot of the examples, cases in the textbook, a lot of the frauds were taking place where they had common names and addresses, because that's where the fraudster can control, say, the post office box of a particular fake vendor, supplier, customer, where they can control the receipt and delivery of mail associated with a fake vendor. All right. Increased past due accounts, increased reconciling items, and so forth. So there are lots of things going on here that can be looked at to look for accounting anomalies. So now let's have a look at 3 cases in the textbook that gives you some hint as to where and how accounting anomalies arose and that they became symptoms of fraud. There are 3 cases. The first case is where an internal auditor noticed a thin line in the photocopied letter in the vendor invoice because the actual fraudster, all right, had a letter that said, the machine needs to be replaced. And in another paragraph, it said it'll be much cheaper for the machine to be repaired. And the fraudster went and Xeroxed a copy of that letter and whited out the second paragraph. They say it was much cheaper and reasonable to actually get the machine repaired. And the internal auditor spotted this Xerox copy because it had a thin line in the photocopied letter and then hinted that something was suspicious. And so that was the discovery of the fraud. And then that led to a larger fraud scheme of equipment purchases by the fraudster. That's our first case. Our second case is where a co-worker noticed a substantial decrease in the asset turnover ratio and pinpointed the problem through an aging schedule of receivables. Now, what was this? This was an accounts receivable fraud. And what happened was the guy in charge, Mark Rogers, allowed its customers to delay the payment of accounts receivable in return for some kickbacks. And as a result, the company lost over $3 million in lost interest, not to mention the $350,000 that was paid to Mark Rogers in kickbacks. So the co-worker noticed the decrease in the accounts receivable turnover. That is, accounts were not being collected as fast as what they were being collected on average. Let's have a look at our third case and what symptom led to the fraud discovery. And that was when the accounts receivable clerk and warehouse manager, they noticed an incorrect credit to a customer. And it shouldn't have happened. It just so happened that the shipping department supervisor took some leave and then made a mistake to actually incorrectly credit a customer, and the customer raised the issue with accounts receivable. And then what happened was they led to an investigation to uncover the fraud. So we're talking about these frauds from the point of view of who noticed the fraud and what symptoms did they see. I'm not really talking so much about the fraud itself, but I'm just showing you how the internal auditor, the co-worker, or the accounts receivable clerk, what did they see that triggered some suspicion of fraud and then triggered some fraud investigation. So that's the purpose of going through these 3 cases, to understand what was the symptoms that led to the fraud investigation. So if you want to read more in the textbook or on the next slide, you can see the summary of each of those cases. Now let's have a look at the analytical fraud symptoms. And this is different from accounting because it goes beyond looking at documentation and the debits and credits. You're just looking for unusual patterns in operations, transactions, behavior of the firm. For example, unusual charges and expenses, unusual human resource signals. It may be excessive employee turnover, physical and cash discrepancies. And you can say that, well, maybe that's accounting. Yeah, a bit of a gray area. It might overlap with accounting. Operational deviations. So we're talking about increased scrap or deviations from the specifications. I know a lot about that in my working with sourcing from suppliers in China and other developing countries. Inventory issues associated with unexplained shortages, excess adjustments, and financial irregularities. In some ways, this might overlap with accounting, but there's other documentation that the analytical process could pick up. And finally, reporting anomalies, strange financial statement relationships that are revealed by horizontal and vertical analysis. So yes, there is a little bit of overlap with accounting irregularities, but here we're really looking for a broader range of strange patterns in the data that is created by the company in its day-to-day operations. Let's have a look at internal control weaknesses, and some of you have already taken auditing or are about to take auditing. You're going to learn a lot about this area. And what you do learn is that we need to have segregation of duties. Those associated with creating contracts should not be associated with receiving cash or paying cash. Lack of physical safeguards, inadequate accounting system, lack of proper authorization, having two people to authorize a certain payment, and maybe two people from different departments to authorize particular payments over $1,000 or $5,000. Some benchmark that doesn't create excessive transaction costs in having that internal control in place. Lack of independent checks, lack of proper documents and records, and what does happen, the overriding of existing internal controls. There was a great case in the early chapters. Remember, one of the bank tellers or bank managers gave a check to a customer who tricked him into believing that that customer had a lot of money in their account when they only had about $13,000. They wrote a huge check, and then the customer just took the money and was never to be seen again. Both the bank manager was fired. They ended up catching the customer. I think that was talked about in the earlier chapters in this book. So there was an overriding of existing controls. The bank manager should have had a second person check on the signing of a check beyond a certain amount. And maybe he bypassed that, signed the check, and then gave it to the fraudster. That's examples of what we mean by different internal control weaknesses. Extravagant lifestyles. Yes, you know all about these. Not that you may have an extravagant lifestyle, but I'm sure you have seen someone near you in the car park, down the street, at the airport that has an extravagant lifestyle. You're probably thinking, I wish I could be there one day. Maybe you can, especially if you become a fraud examiner or a fraud investigator. Yes, it is entirely possible. Extravagant lifestyles, they're probably the easiest to detect because it's when money is converted into a Lamborghini, a Ferrari, a Bentley, right? A high-end car. Money is converted into a luxury house. Money is converted into a limousine, into first-class tickets, into trips around the world. These things are not easy to conceal, whereas the money itself may be easy to conceal. So therefore, this number 4, extravagant lifestyles, is a very important symptom that you can look for and easily spot. Unusual behaviors. Similar to extravagant lifestyles, they may come together, but they may be separate. We're talking about the psychology of fraud here, because remember, the fraudster is trading off their pressure for undertaking the fraud, the opportunity, and then they are rationalizing why they are allowed to undertake the fraud, why it should be okay for them to take the fraud, why they deserve to have the money because the boss is not treating them well, something like that, right? These are emotions post-crime associated with fear, guilt, and stress. There's obviously behavioral responses, unusual patterns, and coping with stress. And then there are changes in behavior. That is, you go from very angry to being very, very nice. And it seems that not a day goes by where you have some predictable behavior. And you just don't know how someone's going to behave, whether the sun is up one day or it's raining, and then the behavior changes like the weather. So these behavioral signals are easily to spot, but difficult to link with fraud. Remember, this is just a symptom that you can put together with other symptoms to try and logically deduce that that person may be undertaking some fraud. So that's 5. Now we get on to the most interesting one of the lot, and that is the tips and complaints. Now remember, let me read out the lines at the top, and I want you to read that with me. Auditors are often criticized for not detecting more frauds. Yet, because of the nature of fraud, auditors are often in the worst position to detect its occurrence. Okay, because the nature of the fraud is day to day. The nature of the auditor's engagement is to come in maybe once every 6 months, once every 3 months, really often, but they definitely come near the financial year to do the stock take, to do some sampling and test different assets in the balance sheet and the profit and loss statement and the cash flows. But in some situations, people are hesitant to come forward with knowledge and suspicions of fraud. So this is a double-edged sword here. We cannot rely on auditors because they're not in the organization 365 days of the year. And number 2, we cannot rely always on employees or management who are in the organization 365 days of the year. Why? Because they might not have complete knowledge or suspicion of what to look for to see if fraud is occurring. Not all employees are born fraud investigators. Wow. Okay, you employ someone not because of their fraud investigation skills. You employ them because they have really good IT skills. They're good at sales and marketing. They're good at product engineering. They're good at something in the organization that enables it to create value for its customers. So let's get into the areas of tips and complaints. So generally, the motivation for tips and complaints can be negative as well as positive. On the negative side, it could be because of personal problems or jealousy. It could be because of anger, divorce, blackmail. It could be that vendors are disgruntled over a lost contract. It could be that customers are feeling taken advantage of. And so they will complain, they will give false tips. So you need to be aware that when you have a tips and complaints hotline and you go through them, you need to take them with a grain of salt, but at the same time, remember them to see if there's anything else that can corroborate that alleged tip or complaint. So it's the first thing about tips and complaints. This is why when you have a tip or complaint, it is not prima facie evidence of fraud because of these motivations, which are a negative side. You can only say that they may be a symptom of fraud, not evidence of fraud. All right. And again, company employees are in the best position to detect, but they are less trained to recognize, as I said, the double-edged sword. At the same time, even if they do recognize some fraud, they may be hesitant to report because of fear of reprisal, maybe because of organization barriers, intimidation by the perpetrator, or uncertainty of fraud or ethical concerns. So these are the barriers for why employees, even if they are knowledgeable of what to look for and they do see something, they still may not come forward for these barriers. You need to be aware that having a tip and complaints hotline doesn't necessarily mean it will solve the barriers to employees given you tips and complaints. Just be aware of that. It's a matter of having a tone at the top, like we talked about in week 2 and week 3, having the right tone at the top that is encouraging of employees, that is giving all employees their sense of value to the organization, and that anything that they say will be listened to and there'll be no reprisals. And that has to come from the top and not just be written in a statement. Finally, the auditors, as I said, a double-edged sword. They're in the worst position to detect, and they're often criticized for missed frauds. They're never around. They just come in maybe once or twice a year to sample, to attest to the numbers put into the accounting statements, the profit and loss, the balance sheet, and the cash flow statements. So there you have it, tips and complaints. And so with that, I want to leave you with the new laws that were brought in after the Enron debacle. There was Enron at the beginning of this century, the largest electricity trader in the US, the 7th largest company in the world at one stage. The new laws to protect whistleblowers and to promote fraud detection. All public companies in the US today have to have a whistleblowing hotline and a system in place, and it needs to be promoted among employees and others. Even after the financial crisis 8 years later, the Dodd-Frank Act came in and authorized the payment of financial rewards to whistleblowers. So often whistleblowers, yes, they get their story out there, they ended up losing their job, they ended up having a reputation for being a whistleblower and might finding it hard to get employed elsewhere in the same industry. And that's happened with a lot of bankers where they did the whistleblowing and yes, they brought a banker down or the system down, they lost their job, but the word got around the banking industry not to employ that particular person. And basically the cost of whistleblowing was just the ending of their career. And so the Dodd-Frank Act was put in place to help substitute for the ending of your reputation, the payment of financial rewards to the whistleblower. I want to finish with one last slide, and I think it actually brings home the point to an even greater extent, and that is the Enron debacle. Because what was the symptom? Basically, it was Sharon Watkins, who worked in Enron, and she was the whistleblower. The Enron debacle was anything but simple. What were the few reasons why it happened? Had management lost its way, or was it a ticking time bomb from the beginning? Many experts summarize what happened at Enron using 2 words, greed and arrogance. But really, it was more than that. It was all about the failure in leadership, the failure to have a tone at the top to make sure that everyone in the organization was squeaky clean, ethical, doing the right thing. But Ken Lay's example was far from being a charitable image. He had contradictory actions. There were no consequences for legal breaches and personal devastations. There were specific incidents associated with travel agency issues, incompetent services, and there was the cultural impact that enabled corruption to breed. As I said, it started with a tone at the top with the CEO, and that really highlighted the whole culture in the organization. And ethical implications, the CEO's ethics, justification of wrongdoing, the employees' conduct that followed that, and other senior management's rationale for doing what they were doing. Obviously, it was total out of control with the senior management at the top, and it just failed to put the right tone and the right ethical culture in place for the whole organization. And that led to the big whistleblowing complaint by Sharon Watkins, and that brought down, in the end, Enron and its associated companies, specifically Arthur Andersen and other organizations associated with Enron. Just want you to finish with that, because in chapter 5, there is the actual letter written by Sharon Watkins that alludes to the problems that we're having in Enron. Remember, this chapter was all about the symptoms of fraud, because you cannot see fraud. It's not like a bank robbery that you see. You cannot see fraud. All you can do is look for symptoms of fraud. The first 5: accounting anomalies, analytical anomalies, behavior challenges, internal control weaknesses, extravagant lifestyles. You can see all these, and then that can point you to starting a fraud investigation. The 6th one could be related to actual evidence of fraud, but it is not, because you do not know when someone gives you a tip or complains is doing it for the right or wrong reason. If they're doing it for the right reason, then it could be prima facie evidence of fraud. If it's for the wrong reason, then at best, it's only a symptom. This is O'Connor in chapter 5. See you in the classroom. Bye for now.